Good morning. I purchased my first investment property in 1994. I think Matt and I are about the same age, actually, because I just had my 40th class reunion as well. So I know how you feel, Matt. It was an REO from Bank of America, and at the time, I really didn't know what an REO was. I was just getting started, but my broker said it was a great deal, so we went and took a look. And when we were walking through this house, all I could think about was what a disaster it was. From the roof down to the foundation and everything in between, it was a total wreck and everything needed to be repaired. But with some trepidation, I took the plunge and purchased that little house for $48,000, which probably doesn't sound like a lot of money now, but back then in Fresno, California, it was a decent chunk of change, especially for me at that time. And so I recruited an unwitting friend who had construction experience to help me rehab the property, and we got to work rehabbing that house. And so we started with the roof, and if you know anything about Fresno, California, in the summer, it's 100 degrees every day in Fresno, and we were up on that roof replacing it all by ourselves, tearing the roof off, putting it right back on. Once we were done with that, we leveled the house because it was an older house, and as older houses do, they settle. So we actually leveled the house. We blew out some walls because, like I said, it was an older house, so it needed some good flow. So I got my design fixed there, kind of reconfiguring the flow. We gutted the kitchen, gutted the bathroom, put those back together, redid the hardwood floors, painted inside and out, and landscape front and back. And by the time we were done with that little house, it was as nice or nicer than any other house in this nice neighborhood that we had purchased. And I had my first rental property. So I kept that property for a few years and then sold it. And for a $5,000 initial investment and some sweat equity, I ended up making $50,000 on that property, which actually that's not too bad. But more importantly, my eyes were open to the world of possibilities of real estate investing and what you could do. And so since then, I've had the pleasure to walk through hundreds of similar properties, but now with the knowledge, vision, and experience to know that these were diamonds in the rough. And so over the course of my career over the last 28, 30 years, I've had more than $100 million in real estate transactions that I've been involved with, and most have been distressed assets similar to this that needed some kind of work. But as we all know, that's really where the profits are on these types of properties. Our senior management team has also had similar experience in a variety of real estate assets over the last 30 plus years. From entitlements to rehab, to ground up construction, to property management, our management team has been involved in more than $600 million in real estate transactions with an average cash-on-cash return of 18%. This morning, I'm going to show you how you can receive years and years of steady, reliable income. I'm going to show you how you can enjoy the benefits of owning real estate like appreciation and depreciation without any of the management headaches. I'm going to show you how you can reduce your risk and diversify your capital across thousands of assets all over the country. And I'm going to show you two funds, one designed for steady, reliable cash flow, and one on a monthly basis, and one designed to take advantage of higher returns. Over the course of the start of this fund in 2015, we've raised more than $84 million in investor capital across more than 400 investors. And our funds have returned more than $18 million in profits to investors during this time. Fund 2 was started in 2015 and is designed for steady, reliable, passive income. Primarily, we invest in two types of assets: vacant land and rental houses. And typically, these assets have two things in common. They're smaller assets, and they produce monthly passive income, steady, reliable cash flow. We'll look at our land parcels first. We currently have more than 1,600 pieces of vacant land in the portfolio. We bought them from a variety of sources, including individual sellers, county tax lien foreclosure auctions, and institutional investors. We typically pay between $500 and $2,000 for a piece of land. And because these properties are distressed, usually with tax burdens, we generally pay far less than what they're worth. Once we have purchased a piece of land, we offer it for sale on our website, Land Central. And we sell these pieces of land similar to buying a book on Amazon. The difference is here, you make a small down payment, and we finance the rest for you. We provide seller financing, and we hold all these notes in our portfolio for long-term cash flow. We sell these land parcels quickly, and we make it fast, easy, and affordable for our buyers. This is a 1.7 acre property in eastern Texas. We sold it online for about 8 times what we paid for it. The buyer financed it with us on a 7-year note. So we recovered our full investment in this property in about 8 months, and then had another 6.5 years of income after we fully recovered our initial investment. With our land model, you can forget everything you know about traditional inside-the-box real estate. We've eliminated realtors, escrow, title insurance, lawyers, and collection companies. And we operate a fully integrated machine that provides all these services in-house, from sourcing the properties to closing on to them, marketing and selling the properties, and collecting payments from the buyers and recording a deed to them when they pay in full. We do every single part of that. A question we get a lot is, how did these land parcels do during the last recession? As you can see, we saw almost zero volatility during the last downturn. You also notice that we've never had a period of time, even during the recession, where our sales prices dip below our purchase prices. Good to know with the predicted upcoming recession. It's always been a very profitable, stable model for us, but don't confuse this with a buy and flip strategy. We're not flippers, we're cash flow investors. We're holding all these notes in our portfolio for long-term cash flow. Next, we'll look at our rental house portfolio. We also buy from a variety of sources: brokers, wholesalers, property managers bring us deals. And the last few years, we've been buying portfolios from a lot of retiring baby boomers who've had real estate portfolios over the years that are ready to spend their golden years down in Florida. Brokers and property managers bring us off-market deals because we've proven to them over the many years that we have the cash, we close on time, and we do business the right way. We've demonstrated that we make commitments and we keep them. In many markets in the US, a house that rents for $750 a month would sell for over $100,000. But in the markets we buy in, we're able to buy homes for that rent for $750 a month for around $35,000. We may pay as little as $10,000 to acquire a house and then spend another $15,000 to $25,000 rehabbing that house and getting it ready to rent. This is a house that we bought in Ohio. We're fixing our houses to meet HUD and FHA standards. Often we rent these houses to lower income and workforce type tenants. And unlike the land business, managing these rentals is a very local business. So we need boots on the ground, and we have local property managers for that. Also, unlike the land business, when we close on these houses, we're closing in the traditional manner using escrow and title insurance. Now, the gold standard of comparing one asset to another is called the capitalization rate, or the cap rate, as you probably know. We see a lot of funds buying assets that produce a 4 to 5% cap rate. Most of our rental houses we're buying produce a 12 to 15% cap rate. This graph shows what occurred with rents during the last recession, and as you can see, even during the worst part of the downturn, rents continued to increase. And when we have the next downturn, which seems to be on the horizon, I expect to see a lot of houses with price fluctuations. just like we did last time, but I believe the impact on our portfolio will be far less because the reduction in a price on a $65,000 house will be far less than the reduction in the price on a $300,000 house. An obvious benefit in investing in our funds is the passive income it generates without the day-to-day headache of management. In addition to that, the diversification offered in Fund 2 spreads the risk out not only across different asset classes, but also geographically across many different MSAs. While we have land in 35 states across the country, our 1,200 plus rental homes are spread across 10 markets in the Midwest and the South. A very unique benefit that you don't see in many funds is the fact that Fund 2 has no leverage on any of the assets in the fund. When a fund uses a bank loan to buy an asset, the bank is in the first position. We don't use bank loans or lines of credit to buy assets. We do not have senior credit facilities. When you invest with us, we're putting you in the first position. When you invest with us, you're getting the security of a note with the yields of an equity investment. And because we don't borrow money, we're not subject to yield erosion when interest rates rise, as we're seeing constantly this year. If you're concerned about inflation, our assets are a terrific hedge against inflation. When you invest with us, you receive a 10% preferred return, which I believe is one of the highest you'll see in a fund like this. The income the fund produces above and beyond that 10% is split 50-50 with you. And if you're an investor that likes to track IRRs, we produced an IRR of 15.7% since inception. In July of 2021, we started Fund 3 to take advantage of managing partner Philip Adler's 35 years of real estate development experience. While Fund 3 is similar to Fund 2 in that we are targeting distressed or underperforming assets where we can enhance and reposition to extract the underlying value and potential cash flow, Fund 3 focuses on larger, longer-term projects in the multifamily and mixed-use spaces. Over Phil's long career, he's found the sweet spot for these projects to be in the $2 to $15 million value range. These projects tend to be too small for the smaller local investor and too large for your institutional investor to bother with. And that is our target range for Fund 3. Here's a great example of a project that we have in Fund 3 and one that we're currently working on. It's a ground-up construction project, a 6-story or 6-unit multi-story building, townhomes with underground parking. All these have rooftop decks that are overlooking the beautiful Hudson River and the Palisades Cliffs across the way. And it's about 20 minutes by train outside of Manhattan, nice little town. In this one, the owner was a distressed seller and didn't have a whole lot of options. The original asking price was $2.4 million, and we bought it for $1.5 million. One of the conditions of closing this property, it had to be fully entitled or shovel ready before we would close. That put the onus on the seller to get the entitlements done. We were actually in escrow for 6 months while the entitlements were completed. And during that time, we had no holding costs while the entitlements and permits were finalized. We broke ground on this project in June. This photo below was taken a few weeks ago of the finished foundation. And if you'll notice to the right of that foundation, there's kind of a sloping hill, might be hard to see. It's about 30 feet above that foundation wall is the old Croton Aqueduct, part of the New York Aqueduct system built in 1907. It's now a walking, biking trailway system. A nice amenity for our future buyers, but a bit of a challenge for our construction team to build without allowing that aqueduct to cave in. And as Al, our construction manager, said, the hard part is done on this project. We expect to have this project completed and the units on the market by mid-year next year. Each unit is expected to sell for an estimated $1.5 million apiece for a total project revenue of $9 million and a profit projection of $1.7 million for a total return on equity of more than 100% in less than 24 months. So Fund 3 has similar benefits to Fund 2 in that you have the passive income. You also have appreciation and depreciation. But in Fund 3, we actually use leverage to further enhance the investors' returns. While Fund 3 offers an 8% preferred return, the real focus of the fund is the upside gains from our value add and repositioning work. Our targeted overall returns in this are in the 18% range. And to give you a side-by-side comparison of the two funds, Fund 2 has a minimum investment of $50,000. Fund 3 is $100,000. Fund 2 accepts accredited investors, and we also accept self-directed IRA funds. Fund 2 has a 10% preferred return paid monthly. Fund 3 has an 8% preferred return paid quarterly. Our process is quite simple. You invest, we go to work, you get a nice return, and you get some really good tax benefits along the way. So why invest with this management team and the Voyager Pacific fund strategies? Well, we've built two complementary funds that provide a high level of diversification and lower the risk for overall investors. And our management team has been consistently successful, not just for the last 5 or 10 years, but for decades. Over that time, we've been through every market cycle and have delivered profits to our investors in each. And we've partnered with key professionals in the business, like our host here, Verivest, our third-party administrator, Gerasi, our securities firm, and Spiegel, who prepares our taxes and does our annual audits. So the timing is great. We've got a number of deals in the pipeline, and we can put funds to work right away. I think the next 12 to 24 months is going to be a great opportunity for acquisitions, so we're lining ourselves up for that. If you'd like to have a conversation and learn more about how our funds can work for you, please get a hold of us. Thank you very much. Any questions? Do we have time? I don't see a timer.
That's right there. We have 2 minutes for the question.
Yep.
How do you increase your net value?
As far as what we do to take a look at, we use a third-party company that takes a look at the various markets that we're in, and they give us the data back, and then we apply that to the assets in the fund, and just basically mark it up based on whatever the appreciation or depreciation is on the assets in the fund.
Is the exit of the fund based on?
Yes. Yep. So folks that came in, in 2015 at $1,000 a unit, I think our unit price is at $1,368 right now. So they've made some appreciation there, and that's included in that 15.7 IRR. Anybody else? Yes, sir. Yeah, so Fund 2 is 24 months, and Fund 3 is 36 months. Fund 3 is a little longer to develop those projects.
We have one more back here.
Yeah, what kind of depreciation do you provide on these assets, on the investments?
That's a good question, one we get pretty regularly. So Jeff Spiegel at Spiegel, our accountant, he says just basically plan on, when folks ask that question, about 25% depreciation is offsets the income.
There are multiples.
Mm-hmm. Yeah, we take care of all that. It's just 1K1, and then we file the tax returns in all the states. Spiegel does that for us. All right, thank you. All right.